Gold has momentum and doesn't need negative rates to hit $2,000 an ounce, State Street Global Advisors says. Now, this comes from a recent new interview from Kitco News with George Milling-Stanley of State Street Global Advisors. Now, you know me. I love weak real interest rates because weak real interest rates love gold. So, why does George Milling-Stanley say that negative rates aren't needed to hit 2000? Could be for a variety of reasons, but I also want to let you guys know that weak real interest rates are good for gold and they are a benefit. And I'm going to rebut what with data what George Stanley is saying because I believe he is referring to nominal rates. He is actually responding to a question that the interviewer asks about rates being dropped by the Fed. So this is what he says. He says, the Fed started raising rates in December of 2015 when gold was at $1,050 an ounce. And then they stopped raising rates in December of 2018, just 3 years later. And in that period, gold went up 20%. And this is in a period when the price is supposed to go down. So I think the relationship is not really well understood. Now, this is my rebuttal. The Fed raised rates because inflation was falling fast. By 2015, the inflation rate was roughly at 0.7. It hit a bottom, essentially. The Fed was left with no choice but to raise nominal rates swiftly so that inflation could get in line. And as we know, gold likes inflation, i.e., gold likes weak real interest rates. Now, in previous videos, I've explained this before. Check out the playlist called Metrics for Gold on my channel. There's a formula there. R equals I minus pi, which means real interest rates equals nominal interest rates minus inflation rates. So if you want to know what the real interest rate is, you have to use that formula. And when you use that formula and you take a look at the gold price over time, you'll realize that weak real interest rates are a huge plus for gold prices. So let's take a look at the data. And before I get into the data, I want to thank Philip Quinn for pointing out every now and then some audio quality issues with the videos. So I actually brought in my microphone. I'm a musician, so I just have a microphone on hand. So bringing in the microphone, bringing out the big guns, and trying to give you guys better quality audio. So let's take a look at where the interest rates were in 2016. Roughly, they were at 0.5 in 2016. Okay, let's take a look at the inflation rate in 2016. It was at 2.1, a huge jump from this huge bottom at 0.7. Notice how the trend line from 2011 went from 3 all the way down to 0.7. So inflation rate was going down, then it popped up to 2.1. Okay, so with the formula, that means that weak real interest rates were actually negative 1.6. So it's 0.5 minus 2.1, which equals negative 1.6. So we had a strong data for the gold price to support a increase in gold price. Okay, let's see what happens in the following year. So in the following year, in 2017, gold or the interest rates were roughly at 0.75, and the inflation rate was still at 2.1. So let's do the subtraction. 0.75 minus 2.1 equals negative 1.35. So the weak real interest rate went up by a little bit. And then in 2018, We have interest rates at 1.5, and let's see where the inflation rate is. Inflation rate is at 1.9. So the weak real inflation is at negative 0.4. So yes, the weak real interest rate started to trend slightly upward, but still it's in negative territory. That's good news for gold. That is why I believe that George Milling-Stanley was not referring to weak real interest rates. He was referring to nominal rates. Let me know what you guys think. About negative rates. Will it actually have an impact on the gold price hitting $2,000? I think it will. Right now, if you take a look at interest rates, take a look at this, man. So we're at 0 for the nominal rate. Let's take a look at the inflation rate right now in 2020. We're at 1.5. So 0 minus 1.5 is negative 1.5. So if we're at negative 1.5, give or take actually, because I believe we're hovering just above 0. So let's say, give or take, negative 1.5. We're not at the lowest point within the last 5 years of negative 1.5, which we had in 2016, but we're getting there. So if inflation goes up, then definitely expect gold to hit 2,000, pretty quickly. But right now, we're getting close to that negative 1.6 region for weak real interest rates, but we're not there yet. So I think if we had stronger negative real interest rates, that would definitely help us get to 2,000. Let me know what you guys think in the comment section below. Please like the video. Please subscribe to the channel if you're new. This is Black Bullion. Have a good one.